Welcome to Daily Wisdom from the Flippening podcast. These episodes feature short, to-the-point clips from our full-length interviews. We talk to the men and women behind the trades, crypto exchanges, and regulations with the goal of helping you become a better, more informed investor.
Hi, I'm Michael Kaplan, editor of the Flippening podcast. Today's episode is from a 2018 conversation with Troy Wong, co-founder and former CFO of Neptune Dash, a publicly traded Masternode company. We discuss why investing in a Masternode company is a cryptocurrency pure play, but investing in mining only offers indirect exposure. For the full conversation, check out Flippening episode 12. And now without further ado, our conversation with Troy Wong, co-founder and former CFO of Neptune Dash. Enjoy.
What's your biggest worry right now? When you disclose vulnerabilities, what do you put as first and foremost on that list?
Our company by design is pure play cryptocurrency exposure, specifically the Dash blockchain. So, the underlying cryptocurrency commodity price really is a double-edged sword in the sense that when things are good, they're really, really good. And when things are bad, they could potentially be very, very bad. When we can see our balance sheet, go up 3 or 4 or 5x in value, and then it can shrink 60% in value as well. Whereas, compared to sort of cryptocurrency miners, the reality is that investors don't view them the same way because most of their capital assets just go to really just a data center and hardware. And so their balance sheet isn't expanding and contracting in value at the same rate that our business would. But that being said, we think there's a much higher rate of return owning the token and commodity itself versus buying mining hardware. And so as long as the Dash ecosystem and the Dash blockchain continues to go up, then we're going to be quite happy with, the returns on our balance sheet.
Something I saw on your deck was that a Masternode business offers direct exposure versus a mining company which offers indirect exposure. Is that because a Masternode business has to own so much of a cryptocurrency in order to operate, whereas a mining company can just immediately get liquidity on the Bitcoin that they've mined and the crypto asset isn't required to operate?
There's a couple of reasons why, we think investing in Masternodes is a bit simpler than investing in mining, like traditional proof of work mining operations. The first thing is, if you think about it from strictly a capital raising perspective, when we're approaching investors, it's a very clear value proposition of what we're doing. We're raising capital, and the majority of that capital is actually just going to go to the token itself. So there's very little sort of operational risk associated with our management team actually having to build out a high quality data center that we think is important. The second thing is, since the majority of our assets are actually in the token today, you're buying digital currency tokens today, right? Whereas when you're investing in mining assets, if you think about it, you're really investing to purchase digital currency tokens sometime in the future. Because what you need to do is you need to go out, you need to raise capital, you need to purchase equipment, you need to set it up, you need to operate in a low cost operational jurisdiction, you need to operate those mining hardware profitably for a number of months and recoup all of your capital investment before you get back to square one. And then, and only then, do you actually start accumulating currency on your balance sheet the same way that we have the currency accumulate on our balance sheet today. So that was meant to sort of illustrate that we love proof of work miners. We just wanted to point out that there are sort of fundamental technical differences associated with operating a proof of work mining company, which also include a hashing rate and difficulty adjustment that's relatively unpredictable. And so we want to just caution investors so that they know the differences between the different types of investment opportunities out there.
It strikes me that what you're doing feels a lot more like passively managed versus an actively managed fund. You're not entering and exiting positions when you think the price is going to drop or rise. You're not having to worry about reinvestment into other sources of income or diversifying across asset classes or crypto assets. It's a very kind of nice, simple business without a lot of operational overhead or complexity, which is kind of cool and refreshing.
I think that's the easiest way for these types of companies to go public and trade. Ideally, every currency would have masternodes, and then we could have a Bitcoin masternode company and a Ethereum masternode company. And because it's simplistic and easy to understand, it allows for the market to quickly value them and for these companies to trade as a proxy to the price, which is the intent. And then you can raise more capital and really build out a very nice balance sheet that allows for sort of like public market capital to enter the cryptocurrency space. Because right now, it's just very, very difficult to do. And there's very, very little opportunity for it, which is why potentially we're seeing this decline in price, because the number of outlets available to pension funds, to sovereign wealth funds, to large public companies that are mandated not to take custody of their own assets, for example, to invest in cryptocurrencies. So we think that creating the simplest vehicles possible to invest in cryptocurrency assets makes the most sense, and it's good for cryptocurrency assets in general.
That's it for today. If you like what you heard and want to support the show, please consider leaving us a review on iTunes, Stitcher, or wherever you listen to podcasts. If you decide to leave us a review after subscribing, we'll send you a free Nomics t-shirt. Just hit us up on Twitter at username Nomics Finance after you've left the review, and we'll hook you up. You may also be interested in Nomics.com, our crypto market cap and pricing website. Check us out at Nomics.com, spelled Nomics. Now stick around for our legal disclaimer. All opinions expressed by podcast hosts or guests are solely their own opinion and do not reflect the opinion of Nomics or any other company. This podcast is for informational and entertainment purposes only and should not be relied upon as the basis for investment decisions. The producers, hosts, and guests of the show may maintain positions in the companies or assets discussed today.